investing. SoftTech turned 10 in May of 2014, so we're now 11 years old. This year, I've been asked to talk about Fundraise the Roof. Disclosure, that's not my title, but anyway. I thought I would basically give you a few updates and thoughts around what has changed in the market in terms of seed investing, really focused on people here want to invest in companies and what it takes for entrepreneurs to really sort of pick the right investors. Brief bio, so born in France, moved to the US almost 15 years ago. And after a startup in the financial services market, I became a VC almost by accident. And then 11 years ago, started SoftTech, 165 investments to date, which is exactly 15 investments per year every 11 years. And those are some of the companies that we've invested in over the years. I started as one of the early sort of angels, became super angel, or was anointed super angel in 2006, and then raised one of the first micro VC funds in 2007, when literally all the micro VCs would have fit on this table. It was actually a large table. Then raised one of the larger funds in 2011, and in 2014, at this very conference, I announced our fourth fund, which is 85 million. So yes, you know, we grew in scale from 1 million, 15, 55, and 85. Just to put things in perspective, I want to share with you the strategy that we've been pursuing with Fund 4. So the target for us is to do 45 investments over 3 years, so the 15 investments per year I mentioned. $500,000 is our basic minimum check we'll write. We'll go up to $1 million to $1.5 million. And the goal for us is to be present for our companies in Series A's and Series B's. Our geography strategy is very, very tight, very limited. So 80% of what we do is here, 10% is in New York, and New York for us is between Boston and Philadelphia. And we've actually annexed Canada as part of the US, so we can say we invest in the US globally. We love Canada. We've done already 4 investments there. Why am I sort of boring you with those details? It's basically the pitch that you as investors want to give to limited partners or people who want to get money from, because it's very important in this environment to actually have a very clear sort of investment strategy. And our goal, and that's really the main difference between seed and Series A, is that we always syndicate with other micro VCs and angels, whereas a Series A typically is done by one fund. Those are the sectors we invest in. And in terms of the new cool stuff that we look at, virtual reality, augmented reality, drones, AI are the things that we're looking at. Few statistics. Fund 4, so close 24 investments since we announced sort of Fund 4, for of 20 million. So we're at 800K average, which is slightly above the 750K sort of target we had. Our average ownership over those 24 rounds is 7.5%, so we're right on target, and we've taken 10 board seats. That will be one of the questions we'll discuss, which is, as a syndicate sort of partner, which of the positions are you trying to capture? Is it sort of the lead? Is it one of the co-leads or main investors, or people who will sort of fill up those rounds? I'll mention the Series A, Series B crunch. You know, there's a debate as to whether there is or there isn't such a crunch, but the point is, the mission of you as investors is to help your companies go from seed to A to B, and it's very important to understand what those sort of hurdles are. So over the last 18 months, we've raised a bit north of $500 million across 35 follow-on rounds through our different funds. Our average Series A was 9 million, average Series B was 19, which is extremely, quite higher than the sort of the average that we were expecting, which was around 6 million for Series A's and 10 million for Series B's. This is what I presented to you last year as the fundraising ecosystem. So it's very important for, as investors and entrepreneurs, to understand where you're going to go and grab. There's the 2015 ecosystem in the next slide, so wait for the pictures. This is very important to understand the different sort of opportunities you have to raise money and what sort of stages and accomplishments that you need to show, you know, to attract this capital. And this is a 2015, sorry, 2015 ecosystem, two or three changes I want to point to. One is seed rounds have become very large. 1.5 to 3 million is basically what we at SoftTech see on a regular basis. Series A's actually are still in the $5 to $15 million range. Series B's have really sort of seen an increase where it's not rare for us to do a $30 million Series B. And then this morning during some of the talks we mentioned SPVs, special purpose vehicles, which are sort of LLCs which are put together by investors to just invest in a specific round of a specific company. And we see them all over the place. So once again, as investors and entrepreneurs, you need to understand that ecosystem because at some point, this is where you will fit and this is where you will play. A couple of thoughts on what has been happening on the seed stage. So it's, think about the first couple of stages I mentioned. It used to be that in the early days when I started 11 years ago, there was this thing called friends and family round. And it was 50 to 100K that someone who really likes you as a founder will give you and potentially will forego because they're friends or family. That friends and family round has become the pre-seed stage where you now have institutional fund that really focus on that first sort of cash that will come in. And at that time, the team is basically the founders. The stage is kind of concept, so you have a PowerPoint, no code, and you will get about 12 months of runway out of a $500,000 round. The investors will be angels, but also those new types of funds that are now sort of targeting that super early stage. And typically SoftTech doesn't play at that level. You then have the seed stage, which is really sort of the first institutional sort of syndicated round where you have the team with the founders and a few engineers. The runway you'll get out of that round is 18 to 24 months. In terms of what will we get, the early data we'll get, it will be sort of a few indications around usage, user acquisition or customer acquisition, and for some companies, some bits of revenue. The size will be in the $1.5 to $3 million sort of range, and the syndicate typically would be a couple of micro VCs and then angels and a few other sources like AngelList. This morning, Gil Pancina talked about his syndicates. We see them in some deals. And then there is the seed prime, seed extension, post-seed round, which is kind of a new thing as well. And I call that sort of a backup to failed Series A, in the sense that if you can sort of go straight to Series A, you will, but if ever you can't really get a Series A, you will go to that sort of post-seed stage. It doesn't mean that you're going to fail, but it does mean that in the market, you just didn't have essentially the validation required to raise that round. Could be not enough traffic, not enough customers, not enough revenues, and so you will go and try and raise more capital at seed stage from a slate of post-seed or seed prime funds, and then your insiders. So what's happening at seed stage in general? So we know that over the last 15 years, startup costs have dropped dramatically, over 10x. However, over the last 3, 4, 5 years, we've seen a gradual increase of operating costs because of the increase in salaries and rent and basically anything that is sort of material as a startup that you need to pay for. So it used to be that you could sort of go through your seed round and hit Series A hurdles with 1 million. That same company would require 2 today. So it used to be cheap. It's still cheap, but it's kind of not as cheap as it used to be. Which is why I'll sort of say that the size of rounds have bubbled not only because there is a lot of capital available, but because it just costs more to run a company for the 18 to 24 months that you need. Because you have 2 or 3x increase in the number of companies try, raising a seed round, because it's so easy these days. When you go and raise a Series A, there are so many more candidates, and therefore Series A sort of funds want to see more in terms of revenue, in terms of traction, in terms of number of downloads. And so in order to sort of get those hurdles satisfied, you just need more time, which means more money. Because we've seen, over the life of my sort of seed investing, when I started, there was maybe $20 to $30 million available from angels to invest in startups. That was back in 2004, 2005. Then, a few funds sort of got raised, and you had 100 million in the asset class, and then, a few more funds. And now we have about, 250 funds that have raised 4 billion. So yes, Anand from CB Insight said it's barely an NEA. NEA is a $3.2 billion fund. But when you think about a 10x increase in the capital available to raise at seed stage, that has just changed the way sort of this sort of stage has been played, in a sense that entrepreneurs have a lot of choices as to where they can raise capital, but not every sort of investor is equal from the standpoint of value add. So we are sort of branded firms, and we definitely have increased our ownership targets as we sort of went along. We started with 3 to 5%, now it's 7 to 10%, and we've compressed our portfolio in order to be able to do more for our companies. And as entrepreneurs, it's an awesome sort of environment to go and raise money, because there are a lot of people who are trying to put sort of their money to work. And the big question is, who is the best investor to support this sort of race of 2 years or 18 months that I'm going to have to run after raising capital to raise the next cash? So our advice to entrepreneurs is to really sort of think about, based on the sector that they're going to play in, what are the hurdles that will exist for them for the next raise. If it's a SaaS company, typically it's around $1 million in annual revenue run rate. If it's a B2C company, call it like a million downloads with a certain sort of level of retention. If it's a hardware company, it becomes trickier, because you need to prove some elements of demand, typically through a pre-order campaign, to raise that Series A. So you really have to understand what are the hurdles and what are therefore the runway implications of clearing those hurdles. 18 to 24 months is our advice. Essentially, one of the reasons why, candidly, we've been so successful at clearing, the Series A, B, and C hurdles for our companies is that we always advise them to raise quite a bit of cash. Some people will have a different strategy. They'll say, hey, you might be able to raise $1 million and, make some progress and potentially either hit the Series A sort of hurdles or raise another $1 million, as a post-seed kind of round. We'll always say, go raise $2 million, because that's what you will need. And, means a little bit more dilution, but at least it improves the odds of doing it. Always sort of research, the best funds for you, because you would be shocked at how sometimes people sort of see, hey, there's a VC in the room, let me go talk to him, even though he or she might actually not invest in the kinds of things that we do. And this is the most important sort of advice to them, is build a foundation that will really help you navigate all those sort of challenges that you will have in the first 18 to 24 months, especially if you're a first-time entrepreneur. And, everyone is familiar with party rounds. They're horrible. Why? Because you have a bunch of people who invest a tiny amount of money and no one cares. And when you get into trouble or need some help, you don't get it. So what that means for investors, this portfolio construction strategy, which I mentioned, is really important. You need to define it very clearly so people sort of come to you to either invest in your fund or get money from you. One of the questions is, do you invest in follow-ons, Series A's and Series B's? It's typically sort of the way you will preserve, your ownership in great companies, and you will sort of make more money when they succeed. I will sort of hammer that one. Your value add is the reason why people will take money from you. So be clear about what you do for them and how you will sort of be able to help. I will sort of get into this a bit more, which is, how much ownership are you worth? Like, it's easy to say, I have a large fund, I want 7 to 10%, but that means that we'll be one of the largest investors and better be ready to step up and help the companies. So we will take board seats, we will help, we will do everything we can, possibly can, to get the companies to be successful. The problem is, if you have a large fund, the question is how much of your fund are you going to invest per deal, and what are the mechanics that will help you so return this fund multiple times. And we've trivialized the $1 billion valuation. Like, everyone is $1 billion, right? But getting $1 billion exit is really, really hard. And a $1 billion exit should return at least half, if not your entire fund, because otherwise the economics of your investments will just not work. I sort of mentioned that a couple of times. And I hear some people sort of saying, yes, I will take the lead, because they think that it's only a matter of putting down a term sheet and setting the terms. It's only the very beginning of the work. And as I said, if you're taking the lead position and aren't fit or prepared to take the board seat, we have a big fucking problem, because no one will actually do the work it takes to make the entrepreneur sort of successful. A few things about how we sort of beat the Series A, B crunch. So there are sectors which are super hot and interesting, and there are sectors which are not interesting at all. Like, try and raise a Series A for an ad tech company these days. Good luck. It's awesome. Which means, to be candid, that when you think about raising, sort of investing in a company, you need to think about the fundability of that company 2 years down the road. And if it's one of those sort of really not interesting sectors for investors, it's very challenging. I talked about, figure out those hurdles and how you're going to beat them. And, one of the tricks we use is to establish very early, almost right after we have invested, who is our list of, top 5 investors who want to go and, get sort of introduced to the company, because if one of those eventually sort of becomes interested and decides to either preempt or sort of makes it easy for us to raise this capital, the entrepreneur will have spent less time and will have done, our job. As investors, and it's true for the first, I would say 4 years of a company, the seed unlocks the Series A unlocks the Series B. And it's, a 3.5, 4-year journey that you need to understand sort of the rules of the game of. And, yes, you might want to sort of invest in a company which is super cool and super interesting and everything, but if ever there's no investor for you down the road, the odds of success have really dramatically sort of reduced. That's a problem with new sectors. An example for you. I invested in a company called Drone Deploy, which is in the drone space. And my assumption was that, by the time they were in need of a Series A, they will have proven enough in this very nascent market to one of my favorite VC firms. 2 years later, they raised the Series A had predicted from the partner had predicted. That's the good news. They did so with 2 weeks of cash left. That means that, between are we too early or are we way too early, they were right at the edge. Reserves are important. I won't bore you too much because I have 1 minute left. But it's important to invest in follow-ons when you have something which is working really, really well. The fact that you will make a high return on your initial investment, awesome, cool. But if it's only 100 or 250K, to return your fund, you just need to put more dollar to work behind that sort of early success. So that's why you always sort of think about those reserves. If you plan to do seed and Series A, reserve 50%. If you plan to do seed, Series A, Series B, you reserve 75% of your fund. But do take into account the fact that, some of your companies will splatter. And so as far as we're concerned, we assume that 20% of our companies will sort of not make it to a Series A, and then 10% will sort of fail afterwards. And recycling is important. Yes, I know I'm out of time. The point is, oops, sorry. Final point is, it's kind of a boring one, but it's really important. If you don't put your fees in the ground, so as fund managers, you have the right to 2.5% management fee. that amount will sort of yield roughly a 25% cut of your fund. You need to recycle your early wins back into the company so you can actually invest the fund fully. Otherwise, you will end up sort of trying to do a 4 or 5x fund with a crutch. Good luck. I'll be around for the rest of the day. And if you have any questions, because I don't have time now, I'll be taking them. And then I'll see you potentially a bit later. Thank you.